After the pandemic hit the world in 2020, many young people stranded at home started looking for new ways to make money. And this has given way to a new wave of young, inexperienced investors. If you are one in this new generation interested in investing, or if you are considering investing just now, listen up. Beginners in investing tend to make several mistakes, most of which are probably out of enthusiasm or impatience, and in many instances out of sheer ignorance. Just like any other trade, it is crucial for beginning investors to try and learn from the best out there, but it is equally important to learn from the worst as well. Hello, and welcome back to the Ring of Knowledge, your trusted source of practical financial knowledge. In this video, we will go over the 10 most common mistakes in investing to help you avoid them. But before we start, check out our video about 10 money mistakes you should also learn to avoid if you want to have financial freedom. And now, without further ado, let's get right into it. 1. Starting to invest before you prepared for it. There are two different ways to be ready to start investing. The first is financial, and the second is mental. So even if you did start investing along with the new surge of investors during the pandemic, take a step back and be better prepared to fix your investing life. It is crucial to pay off all the high-interest debt you have accumulated before considering any investment. Let us talk numbers. Your current debt, say for a credit card or whatever else, has 18% interest per year. If you want to make any investment you go into to be profitable for you financially, you need to invest in something that will provide more than 18% annually. However, the average annual return in stock market is around 10%, and at many times much less than that. Your investment would have been more profitable if you put that money into paying off your high-interest debt. In terms of being prepared mentally, you need to start thinking in an intelligent way. The money you invest shouldn't be needed any time in the near future. Investment is a long-term plan, so think ahead and have savings accounts for emergencies before you start investing. What if your car broke down and the last penny you had that isn't meant for your monthly expenses is put in an investment? If you do not have an emergency fund, you'd need to pull your investment money too early and sometimes face some losses. 2. Having idealistic expectations. Investment in the stock market is a long-term plan, and dreaming of becoming quickly wealthy can be extremely discouraging and disappointing for new investors. When you are considering investing, think about your retirement, and think that you will have enough money when you are in your 50s or 60s. And do not think that you will become wealthy right away or even in a year or two from now. And taking that into consideration, never invest using money that you might need in the near future. If it happens that during the next 2 or 3 years we plunge into a bear market, it would take a couple of more years to have our investments recover. Do not have too high of expectations when it comes to your investments. As previously mentioned, you can get an annual return from the stock market of about 10%. In some really good years, you might get even more than 25%. But in other years, your return might face some losses, and you'd see it plunge by 25% and sometimes even more. Make sure that you are aware of the volatile nature of the market, and do not put extremely high expectations for what you might earn back. 3. Racking up trading fees. Whenever you invest, you should be aware that you need to pay commissions. It is crucial that you try to avoid paying high fees for your brokerage services, as they tend to pile up. This needs to be evaluated carefully in terms of how much you invest and how often you trade. Try to aim never paying more than 2% about your overall trade value. With simple math and thoughtful consideration, you can be aware if the investment you're making is worthwhile or not. Let us take an example. If you are trading $1,000, you shouldn't pay more than $20 in trading fees. In common, most brokerages charge trading fees around $7. If you'd like to start a small investment, take this into account. Starting with $100 investment and paying $7 as fees is not worthwhile, because 7 represents 7% of your trade value. To break even, you'd need your investment to grow by at least 7%, putting your investment money at risk. So consider starting with $350 instead to make your fees 2% of the value you invested. 4. Getting too excited and frequently trading. It is very easy for investors to fall into a trap of enthusiasm. So you're just starting to invest and you're following the latest news of all the companies you can invest in. You find something that looks promising, so you put your money in. But then better prospects turn up, which might help you gain some more. So you sell some of your shares you already invested to buy into other companies. Well, as exciting and promising as your trade might be, you actually just started racking up trading fees with buying and selling. Secondly, this might eventually cost you more in terms of taxes you'd have to pay. If you buy and sell a stock within a year and it made you some profit, it might be taxed as short-term capital gains instead of lower rate of long-term gain. So regardless of how much profit you think you might be able to get from a short-term investment, try to restrain your excitement and always remember that investing is more profitable in a long term than it is in short term. 5. Having too much faith in a few stock. Having passion and faith in the prospect of a certain project or a company making it big isn't particularly wrong. It would be so if your faith in this company doesn't allow you to see some facts. You might think that if I put all the money in one stock and this stock ends up doubling, it would give me the opportunity to double my money. And this is technically true, but you also need to be aware of the other side of the coin. If that stock you have so much faith in ends up having a bad year and drops by 30 to 40%, all of your portfolio would be dropping that amount as well. If you are wondering how many stocks your portfolio should include, there isn't a magic number. However, keep in mind that the more stocks you invest in, even if the investment value is small, the less your risk would be. Try to aim at having no less than 15 stocks in your portfolio to lower the risk of you losing a lot of money in case a few of them drop down. 6. Investing in a handful of industries. Another common investing mistake is putting your money into a few industries at a time. This is different from the previous mistake we just made. So let's say your portfolio includes 20 stocks, which is a very good number. However, if you look at the industries you invested in and you see that 10 of them are manufacturing companies and the other 10 are energy companies, then you've fallen into a mistake. Many young investors prefer to invest in industries they understand or in industries they believe would never lose money. But remember, if we ever go into a recession, half your stocks would drop down. And a major change in the price of gas or oil would see your other half go down as well. So always aim to diversify your portfolio in terms of the industries you are choosing. Don't forget to consider some international holdings and not just stick to national stocks. This would ultimately lower the risks of you losing a lot of money, even in the worst financial crisis. 7. Forgetting to follow up with your investments. If you've tried following the advice up till now, and you've invested in 15 to 20 different stocks from 7 to 10 different industries, you've got a lot to do now. Even if you're sensibly considering buying the stocks and holding on to them for long term, you cannot just forget about them completely. You should always keep up with the latest news and prices of your stocks, along with the other stocks you might be considering. Try to at least keep up with your stocks every quarter by checking their financial reports and following the company's strategy and management. Year after year, you'd be able to know if the company is doing as promised, and if everything is going according to plan. You must be aware if there are any new developments, a new product they be launching, or if sales are dropping. Whatever happens to the companies you've invested in, you should be one of the first to know about it. 8. Buying a plunging stock. Let us say the stock market is going through a bear year. You might have heard that this is the best time to buy more stocks because at such times, they can be bought for less money. While this is true in most cases, do not fall into the trap of getting more shares of a stock that seems to be dropping in value. You might find that one of your stocks now costs less, and you think it would be wise to buy some more as it could increase your profit when it finds its way up in the future. However, you should always think more broadly. If one stock seems to go down, it must be falling for a reason. So before jumping into what seems to be an opportunity, do your homework. Try to find out any reasons why the stock is plunging and do not buy more stocks until you are certain that the company isn't facing any major issues that aren't temporary. 9. Buying on margin. Many beginning investors get their hopes up too high and might consider buying on margin. What this means is that you acquire a loan from your brokerage and use the funds to invest. For example, let us say that you want to invest $1,000 in a stock that ends up turning 50% annual return. This gives you $1,500, which is great. But you might think if I invested $2,000 instead, I'd eventually get $3,000, which is actually even better. So I put in $1,000 and borrowed the other. This is completely legal and can indeed give you more profit, would cost you a lot more if you'd end up losing. If you faced 50% loss instead of gain, your $2,000 would be worth $1,000 instead, the same amount you borrowed, leaving you with nothing. This is without taking into account any interest you'd have to pay, so you'd actually end up owing money to the brokerage. 10. Not investing in your own knowledge about investing. The best investment you can do is in yourself. Keep learning. Read about and listen to great investors, and keep learning about successful as well as failing businesses. Check out how different management styles affect the performance of companies. This would give you hints on whatever company you are considering to invest in. You should also understand the different industries you want to take part in. And you should always be aware how the companies you are investing in make their money. Keep reading, looking up informative videos, and investing in your knowledge. You must know by now that investing needs some basic math and figuring out the amount of your profit and loss, and the number of fees you'd have to pay. If this is a weak point that you have, work on improving it. Learn business and finance to keep evolving in everything you consider doing. What you gain from investing in your knowledge will never be lost. Let us know what your investing mistake was and what you want to do to avoid it. Share with us your thoughts on the biggest mistake you believe should be avoided when it comes to investing. Don't forget to give this video a thumbs up and hit that subscribe button to never miss any new content like this one from our channel. See you in the next video. In the meantime, keep investing.